The clock's ticking down ruthlessly to 30th June, and right now, the ATO's preparing to claw back a massive chunk of your hard-earned wealth. If you've got over $300,000 sitting inside your accounts, you're standing directly in the crosshairs of the taxman. This e-offie. It's an absolute financial disaster if you choose to remain passive tonight. Every single day you delay your strategy, you're voluntarily handing over thousands of dollars in clean profits to the government coffers. The institutional system isn't designed to protect you. It's designed to tax you to the absolute limit unless you know the rules of engagement. Today, you're going to master the exact institutional framework required to legally claim a $30,000 tax deduction. To maximize your super balance before time runs out completely, we're completely stripping back the complex financial curtains to reveal the sophisticated strategies that Australia's wealthy elite deploy to shield their retirement nest eggs from brutal, marginal tax thresholds. Please remember, this video contains general educational information only and does not constitute personal financial, taxation, or legal advice. But if you're truly serious about halting the wealth erosion immediately, you must comprehend how these mechanics operate before the midnight deadline strikes on the 30th of June. There's a massive gulf between blindly leaving your money in default strategies and taking aggressive, sovereign control of your financial legacy before the financial year closes forever. Let's dive straight into the hard technical math dictated by the latest ATO regulations for the 2025-26 financial cycle. The statutory concessional contributions cap has officially been adjusted up to a maximum of $30,000 AUD for every single individual. This represents a rare, highly lucrative window to deploy pre-tax dollars straight into your account, effectively crushing your personal taxable income for the year. If your personal salary puts you into the upper brackets, earning anywhere from $135,000 to over $190,000, your top marginal tax rates are sitting at an oppressive 37% or 45% under the newly implemented Stage 3 tax structure. Think about the raw numbers for a moment. Without an active tactical plan, you are willingly handing over up to 45 cents plus the Medicare levy on every single dollar you earn above those heavy thresholds. It's a massive wealth destruction event that occurs silently every pay cycle. By setting up a highly structured, legally compliant salary sacrifice arrangement directly with your employer's corporate payroll division, you can immediately intercept your gross salary before it ever touches your personal bank account. Instead of allowing that cash to be decimated by personal income tax rates, you route those dollars straight into your fund where they are, hit with a flat, heavily discounted concessional tax rate of just 15%. That's an immediate, guaranteed tax differential saving of up to 30% on every single dollar you transfer. However, you cannot simply guess your numbers because your employer's mandatory super guarantee contributions clear into that exact same $30,000 annual cap. If you blindly execute additional personal deductible contributions without accounting for those base payments, you'll slam directly into excess contribution penalties. The ATO will aggressively tax those excess amounts at your highest marginal rate, completely destroying the tax. To prevent this catastrophe, you must log into your corporate portal today and calculate the precise dollar amount your employer has contributed since 1st of July last year. Do not assume the numbers on your payslip match reality, because the fund must actually receive the cash for it to count toward this current cycle. Many major corporations delay their internal quarterly clearings, meaning your final quarterly contribution for the previous financial year might have actually landed in July, consuming a portion of your current $30,000 allocation. It's an intricate mathematical ledger that demands complete institutional oversight and granular precision if you want to successfully outmaneuver the tax office's automated auditing systems this month. Let's halt everything for an abrupt, dead stop right here. Take a hard look at your total retirement balance on your phone app right now. If you're feeling completely overwhelmed by these complex rules, or if you believe your hard-earned wealth's being quietly eroded by excessive taxation and poor fund management, stop scrolling and drop an immediate comment right below explaining your exact financial pain points. Let's expose these institutional flaws together and build a community of defensive wealth builders who refuse to give up their hard-earned capital. Now, let's transition deeper into the operational structural risks that are actively threatening your capital accumulation. You must urgently evaluate where your retirement capital is physically held. Are your assets parked within traditional industry funds, or are you stuck inside old-world, high-cost retail funds? Retail funds are notoriously famous within the wealth management sector for layering complex administrative platforms, hidden entry charges, trailing commissions, and default investment profiles that silently siphon off your compounding interest. Year after year, you must demand a comprehensive fee breakdown from your provider immediately to ensure your current asset allocation is actively maximizing market returns rather than fattening the profit margins of a commercial banking institution. Next, we must confront the hidden wealth tax, known as the Division 293 Assessment Framework. If your adjusted taxable income combined with your low-tax concessional contributions scales past the $250,000 threshold for the year, the ATO will immediately levy an extra 15% tax on your superannuation contributions. This effectively doubles your internal fund tax rate from 15% to 30% on those specific inputs. It's an incredibly punitive trap that catches thousands of successful corporate professionals and expanding contractors over 45 completely off guard every single year. When that specialized Division 293 bill arrives months after you've lodged your tax return, you're forced to make a critical strategic decision on whether to pay the liability using outside personal cash reserves or execute a formal release authority to draw the funds directly from your retirement balance. Choosing incorrectly can drastically disrupt your long-term compounding speed, but the absolute most lethal financial landmine waiting to destroy your wealth this month is what we call the BPAI death trap. Every single year, thousands of well-intentioned Australian professionals log into their internet banking portals on 28th June, 29 June, or the afternoon of 30 June, transfer tens of thousands of dollars via BPay and rest easy thinking they've secured a massive tax offset. This is an absolute, irreversible tragedy. Under strict ATO legislation, a voluntary personal contribution is only legally recognized in the financial year that the capital is physically received and cleared into the fund's master bank account, not the day you authorize the payment on your mobile app. BPI transactions route through complex clearinghouses and can routinely take up to 3 or 4 business days to fully settle. If your capital clears on the 1st of July, your tax deduction for this year is completely dead. You lose the entire tax deduction for this current tax return, and you accidentally flood your cap for the next financial year, triggering massive compliance headaches. The single highest value financial insight we can deliver to you today is to execute your electronic asset movements immediately, without a single day's delay. Do not leave your wealth survival to chance during the chaotic final week of June, when banking networks experience massive volume overloads. By taking proactive control, transferring your personal deductible capital weeks ahead of time, and tracking the payment until you see a cleared confirmation status inside your fund's electronic ledger, you permanently lock in that $30,000 deduction and safeguard your wealth from predatory taxation thresholds before the gates slam shut on 30th June. Remember, this is general information only, does not constitute personal financial, taxation, or legal advice, so always verify your specific limits with a registered professional before transferring large sums of capital. If it completely shocks you to discover how easily these institutional traps can wipe out your hard-earned profits, you must prepare yourself for our next urgent broadcast. In that upcoming video, we're going to expose exactly how to stop bleeding money to the tax office and rescue $30,000 in default fees to protect your super balance over the long haul. Hit that subscribe button right now to lock in your alliance with Aussie Super Secrets and ensure you never give the ATO a single cent more than the absolute legal minimum. We'll see you in the next strategy session. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.